we have fallen in many ways on bad times from about 1975. From about 1930 to 75, everybody got richer at about the same rate. And now, 50 years later, the Japanese CEOs earn 40 or 50 times their average worker. And we yield about 250 to 400, depending on who's doing the calculating.
At the top of the list of the world's most successful and respected investors, Jeremy Grantham is warning of a new alarm: rising inequality and corporate greed in America. Having analyzed the trends of markets and economic conditions for decades as co-founder and chief investment strategist at Grantham, Mayo, and Van Otterloo, he is uniquely positioned in the financial world. That's why an eyebrow went up when, during a recent interview, he talked about the widening income gap and excessive CEO pay. Here's what he had to say. But first, make sure to hit that subscribe button because it's my goal to make you a better investor by studying the world's greatest investors.
When you put a bunch of your buddies on the board and you decide to give yourself, $200 million of stock options over 3 years because they're your friends, that isn't capitalism. That is stock option culture gone wrong, and it has been aided and abetted by increasing monopoly. Every industry in America has become more concentrated, and in more recent years, you have had the fashion of cutting back on capex. Capex is real life. It's up and down. It's unpredictable. It makes your earnings volatile. Who needs capex? So let us use that money to buy our stock back. Buying stock backs is said to be a dividend. It has many dividend-like qualities, but it has one incredibly significant difference, and that is a dividend goes neutrally to everybody, and stock buybacks constantly take out the least optimistic of your stockholders. And if you can find a way month in, month out of getting rid of your least optimistic stockholders, you better believe you're living in a different world from a bland, universally delivered dividend. And so you push the stock price up, and the evidence is completely compatible with that view. A combination of all these things has increased the inequality, has enabled the excessive payment of most CEOs who, to be friendly, bring along a handful of their top management with them and bear down quite hard and quote, efficiently, or hard-heartedly, you could argue, if you were a humanitarian. They bear down on the workers. And in that, the government has helped them along.
Understanding the economic inequality that Grantham is talking about requires understanding CEO pay and stock buybacks. A lot of times, companies make a decision to buy back their own stocks as opposed to paying dividends, which thereby impacts its stock price and shareholder value. Consider a company that decides to buy back its own shares using part of its profits. This creates a scarcity of the shares in the market, leading to the remaining shares having a high share value. This can be beneficial to some extent, but the benefits are mostly concentrated on major shareholders and top company executives who receive stock options as part of their pay. This leads to wealth concentration at the top of the pyramid, which increases economic inequality. The point that Grantham is making is that companies are not reinvesting in capex. They are, rather, buying back their stocks to make the share price go higher and pay bigger salaries to their executives. Data from the National Bureau of Economic Research shows that stock buybacks in the U.S. increased from $100 billion in 2003 to over $800 billion in 2018. What this ninefold increase does is simply indicate how reinvestment has given way to stock buybacks, with a resultant growing income inequality. Furthermore, Grantham points out that this practice has contributed to the increasing income inequality in the U.S. By focusing on stock buybacks, companies neglect investments that could benefit the broader economy and create jobs. Instead, they enrich a small group of executives and shareholders. This dynamic is evident in the growing disparity between CEO compensation and average worker wages. For instance, in 1980, the typical CEO made about 30 times what his or her typical employee made. Today, it's closer to a 300-to-1 ratio. This dramatic contrast illustrates well Grantham's argument of rising inequality, deriving from corporate practices and government policies.
Government has allowed the inequality, the Gini ratio, to worsen in the U.S. through every administration except Bill Clinton's, where it was flat. He did not generate enough momentum to send the pendulum swinging back a bit, but he held it for 8 years. And nobody else, including Obama, did. It continued to become more unequal. And in more recent years, of course, the whole tax structure has been moved away from capital, therefore, by default, to labor. If you lower the tax on dividends and interest and capital gains tax, you must understand that you are increasing it on everything else, which is to say, the ordinary people. And that has been a very profound transition. We are now as unequal as Mexico and Brazil. And we used to use them back in the 60s and 70s as kind of the robber barons. And now we're with them. It's not that they have improved, it's we have joined them in an equally unequal society. Yeah, I don't see it as papering over, but it is undeniable that if you push up the price of assets through pushing down interest rates, you will increase inequality because the rich own the assets and the poor do not.
Yeah.
And that is precisely what happened. And I think the Federal Reserve has played the biggest role in doing that. Greenspan and his, it appears almost as acolytes since then. They have all followed pretty much his flight path. So yes, that increases inequality. And when you lower the rates, you also make debt available to people who can handle borrowing. That is to say, private equity and hedge funds and leverage in general. That is a windfall gain. You're giving free money for these marginal economic activities. The only purpose in which really, when you look at the bottom line, is the enrichment of the people who run the private equity firms. The value created for society is negligible, according to almost every academic study. And they have pretty good lives. But and they are some of the main beneficiaries, and they change reality by bidding up the price of corporations and helping increase the overpricing of the stock market. It used to be considered, for example, that a stock buyback was manipulative, and it was illegal until the mid-70s or later, all the way from the 1930s. You have to have a policeman at the corner of Broad and Wall in order for things to work pretty well. You have to keep an eye on them. And other things being even, to have companies buy their stock back whenever they feel like it, and it's not a great idea. I think let them pay a dividend, but let them keep their nose out of the stock market. It is too easily manipulated and was banned for a very good reason and was unbanned for also a very comprehensible reason, which was to be nice to corporations. And it is nice to corporations, and it's a big part of the inequality equation.
Grantham's proposal for reform is clear. Reinstate the ban on stock buybacks, reform the Federal Reserve's responsibilities, and ensure a fairer tax system. By addressing these issues, Grantham believes that we can reduce inequality and create a more balanced economic system. His call for greater corporate responsibility and fairer compensation practices is a crucial step towards achieving this goal. First, reinstating the ban on stock buybacks would prevent companies from artificially inflating their stock prices and instead encourage them to reinvest profits into growth and innovation. This would benefit the broader economy and create more jobs, reducing inequality. Second, reforming the Federal Reserve's responsibilities would involve focusing on maintaining a stable economy rather than manipulating interest rates to benefit the wealthy. This would help to level the playing field and ensure that economic growth benefits everyone, not just a select few. Finally, ensuring a fairer tax system would involve increasing taxes on capital gains, dividends, and interest to ensure that the wealthy pay their fair share. This would help to redistribute wealth more equitably and reduce the growing income gap.
I wouldn't mind reforming boards, too, to make sure they had one or two worker representatives in the larger corporations and one or two outsiders and not wall-to-wall friends of the chairman.
Or maybe one or two stand-ins conceptually as members of other species who have no say in our economic decisions.
Yeah. By the way, when people say to me, what should America do? My semi-frivolous answer is we should hand over our government to a consortium of the Scandinavian countries. Norway, Finland, Denmark, Sweden, Lord knows they have to get elected. They have on paper all the problems that we have in that respect, and yet they have sensible policies aimed at the well-being of their people. On social measures, they do better in everything than we do. The life expectancy in Sweden 30 years ago was 2 years longer, and now it's 8 years longer. When do we blow the whistle and say something is going drastically wrong?
Grantham is appreciative of the Scandinavian countries and shows it by how he views them as countries that implement reasonable policies in the interests of all the people. These countries consistently beat the U.S. in many social indicators, such as length of life and scholastic achievement, which indicates there is something to be learned from their style of government and the concept of social responsibility that permeates the culture. Life expectancy at birth is 83 years in Sweden compared to 77 in 1989, whilst in the United States, it has only increased by 75 to 78 years over the same period. This difference illustrates how social policies and healthcare systems can affect well-being. Grantham's words reflect the difficulties that any system faces in providing well-informed citizens who are capable of making sound decisions. He thus emphasizes the need for processed information and a long-term approach by governments to ensure rational policies. Grantham's thoughts on the social contract and societal responsibility remind one of the importance of community and collective well-being. His admiration for the Japanese response to COVID-19 reflects a real lesson on the power of social cohesion and sensible behavior in these times of difficulty. As we grapple with these very hard economic and social problems, Grantham's insights offer valuable perspectives in creating a fairer and more equitable society. For example, during the COVID-19 pandemic, Japan's approach emphasized individual responsibility and social cohesion. Although masks and vaccines were not mandated by the government, most citizens in Japan wore masks and took the vaccination, and the death rate was much lower compared to the U.S. These behaviors indicate a sound social contract and a collective commitment to public health. So there you have it. So do hit that subscribe button because my aim is to make you a better investor by studying the world's greatest investors. Again, speak to you soon.